Good evening, everyone. Thank you all for joining in on a Saturday evening. I think my first question to all of you would be, what is the score? Because I haven't been following the match, uh, but I will take you through the presentation. It's quite a long presentation that I have prepared today, and I'll try to take it a little fast. Thank you. I think somebody has commented that there's rain, so thank you. I don't think I'm missing enough. So how many of you have actually seen this movie, Everything, Everywhere, All at Once? So the movie is an Oscar-winning movie, and the story is very complicated, but it had one fundamental message that our minds are everywhere. Whatever we do, any random act can impact our action, and in turn change the future. Right? So I think we are all in this together. Everybody here understands that when you have to look at how you save, you have to consider everything. Right? What is this investment doing? What does this product mean? We have to consider so many things that we get confused. But there are so many decisions to make. So we are literally there. We are everything, everywhere, all at once. Right? So I thought that let's actually address what are the fundamental things that we should only look at. Right? Rather than doing so many other things, what are the things that we should actually go out and look at? First thing is setting up a milestone. How can setting a milestone really help you? What is a milestone? Milestone is basically a target that you have set for yourself, right? That I am going to do this, I'm going to achieve this. And to achieve that, I need to do certain amount of work towards it. Right? Now, this is basically a power of a habit. Right? Your step one to setting a milestone is to create a savings habit. Now, think about saving every day. Right? You have to create a habit. A habit takes 20 days for it to develop into a habit. So today, if I get up and say, no, from tomorrow onwards, I'm not going to do this, the first thing that I'm going to do is get criticism. That no, what you will do, you cannot do it. No, you have to power that through. You have to push through that. So first step is to create a savings habit. Cut down the slack. Stop spending on unnecessary things. Rather think about saving every day. Little by little, think about saving every day and review your progress. Right now, these are big tasks that you set up for yourself. Right, habits are big tasks. Right, and you need a win. So every time you review your savings, review it every week because you know that you've made progress. It's going to motivate yourself. You're going to motivate yourself to save every time. Right? And next thing is, once you know that, okay, I am capable of a lot more, you are going to push yourself towards saving more, towards a particular target. Right? Your next step, once you know that, okay, I am able to save this much, what do I do with these savings? Your next step is to create an investing habit. Right? Two vital steps is all that is required for you to actually go on that path of setting a milestone for yourself. Right? Set up a monthly SIP. SIP is the best way for you to get into the habit of investing. Right? Once you figure out how much you can save, SIPs are the best method for you to go out and saving. Once we go through the presentation, I'll actually have some very small amount of data for how do you get into the habit itself of SIP. Right. Invest whatever surplus you get, whatever bonuses you're able to get from your work, whatever extra savings you have at the end of the month, end of the year, end of the quarter, or end of 6 months. Put that into a mutual fund, put that into your savings, create a habit out of that, so that you know that if something is not just there lying, it's not earning money, not at the same time you're not going out and spending it. Right? Two steps: create a savings habit, get yourself on track. After that, create an investing habit. So let's set up an actual milestone. Right now, the milestone that I want to set for all of you now is your journey towards 1 crore. Now, how do you get to that 1 crore? The mentality that's required. Today, the match is happening. And today, I think we're playing with Shardul Thakur instead of Mohammad Shami. Second, Shreyas Iyer is what I read, has come back after injury. He got back after a week. He got the call immediately after he got all right. Right. But what is the mentality that is required for him to go outside today on this pitch and face bowlers like Shaheen Afridi and Harris Roth? Because we've seen Virat Kohli do it, and Virat Kohli can only do it because of his mentality, right? Your journey towards that 1 crore requires you to have a particular mentality, and today we're going to take stock of that. So planning your finances allows you to write your own story in retirement. It's as simple. This is why I highlighted planning and finances, right? You have to start setting up a plan for yourself, right? Habit is one thing, but acting out on those habits requires you to plan your finances so that you write your own story in retirement, right? So keep this in mind. Step number one is to start planning. Okay. Now, getting a few things right will pay you off when you have to make a plan. Have a budget, ensure yourself, be tax efficient, diversify your savings, manage your loans well, and plan for your future. So here I'm just going to address a couple of things. One is to ensure, and the other one is to diversify your savings, right? Only then you can plan for your future. Just getting these two itself will not allow you to take loans. You're not going to take a loan once you realize your entire assets and liabilities and see where you're currently standing. After that, if you still manage to do that, then that is another area which we will cover much later, maybe in a webinar later, right? But the first thing is to have a budget. Like I said, when you create a savings habit, it pushes you to create a budget, is to have a budget, right? Only then will you be able to get into that habit of investing. Only then will you be able to diversify those savings. Only then you'll be able to insure yourself. Only then you will be able to have some sort of an emergency reserve for yourself where you can get a few right things that will pay off for you incrementally in the long term, right? This is why you have to plan for your future. Planning is very, 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 very important for you when you have to take stock of what you need to do. Okay. So where is your money really, right? Let's say 80% of your money is in real estate, which I think most Indian households are. Our legacy wealth does come from real estate. Most of our money is locked up in real estate. The reason why it is locked up is because you will not find a buyer immediately tomorrow if you want to liquidate that particular amount of savings, right? Rental yields are at 3 to 5%, which means that incrementally for you to grow at a very high rate, this is not for you to growth does come 20, 30 years down the line, 40 years down the line, because it's generational, right? And income is not necessarily stable. This is what happens with rent. You have to go find another tenant. You have to go, if it's a commercial property, somebody has to come. You have to make sure that everything is intact for you to get that rent continuously coming into you. Next, again, legacy is fixed income. We've always had a large chunk of our money in FD. And FD rates are quite low, and it's unsustainable in the long run because we will not be able to grow, and we are aspirational. We all want to grow at high rates, but fixed deposits do not offer you the same yield as what they used to offer in the starting of 2000, that entire decade where interest rates were very high. That is when our country was going through a transformational change, and today the scenario is very, very different. So as per today's scenario, you do not make more than 7.5% in your FD, right? That is your SBI FD. So it's not sustainable in the long run. Inflation is very high. Costs only keep going up for us because we are aspirational in nature. We will only spend more. We are only going to spend more. Today, iPhone is supposed to release now in the next iPhone is coming now on 12th or 13th. That's where they're going to launch it. And the first thing that we're going to do is go and swipe our credit card. So we are aspirational. We are going to spend more. And either ways, our household expenses itself are growing, which means that we are going to require a much larger corpus if we are to grow at 7.5%. Right. Then you have equity. This is where our guts comes in, where we say, no, I can't grow at these levels, so I take a lot more risk than what I'm supposed to, right? I don't consider risk. I only start setting return expectations, and that sort of creates that mentality in me that I only have to take risk, and I'm only going to go down the decision chain because I'm only willing to take more and more risk. That doesn't mean I will keep on making more returns. right? You're going to build a volatile portfolio for yourself if you don't manage your equity portfolio very well. And if somebody has some sort of capital preservation or income generation like that of an FD mandate, then you will not be able to make any income out of it unless and until it's a dividend paying stock, right? And there are bouts of when the market does extremely well and the market does extremely bad, right? So for somebody who's a conservative investor who wants to grow at a steady pace, who doesn't want to go at the speed of a Porsche or a Lamborghini, but wants to go at a steady state to that of a proper SUV that Maruti builds, then it doesn't suit your goals, obviously. So it's not ideal for your short-term goals, right? People think that they will put some money in the market and make some money out of it to fund for vacation or to fund for a 3-month or a 4-month commitment that is coming. It's unsustainable because you don't know how the market is going to react, right? So traditionally, we have been in these asset classes with another mindset. But if you do have that mentality, you can definitely change it only by doing one thing, right? Asset allocation. Now, you need to have a bit of everything, but you do not need to have too much of anything, right? You need to have some bit of cash for your liquidity needs, for you to it's just safety. It's just a safety net for you. If something happens, you definitely need to have at least 6 months worth of expenses for you lying in cash that you can use. Obviously, you require gold and silver here because it's an inflation hedge, right? Your at least 5 to 10% of your net worth should be in precious metals, because precious metals, nobody needs to know about why they are precious. I already covered it last week, where I did talk to you about gold and silver and one step forward with gold mining also. So 5 to 10% of your net worth is a very good allocation for you to keep. Your FD, naturally you need to preserve some money that's growing at a low rate where you need regular returns, right? It may not beat inflation in the long run, but it does provide you that regular income that you require, right? That can be at least 20% of your net worth. Now, because we have to buy a house, we do take pride in having our own house, and we have goals that we want to build our own house. We live with our own family. So definitely real estate does come into the picture because it does give us some sort of an emotional security. It does give us some sort of financial security that if anything happens, I still have my house, right? So it does give you that perception of financial stability, right? But it is capital intensive. Today, house rates are very high. The rate at which property prices are going is skyrocketing, right? So anywhere where you want to buy a property, you need to save a lot, right? And our suggestion is to have at least 40 to 60% of it in your entire wealth tied up in real estate, not more than that. Unless you're running a business out of it, that is a separate case. But if you're an individual, then that is all that is required, right? And then comes equity. You should not go beyond a particular level in equity. You do need to diversify your assets. They do give you high returns, but they only give you high returns if you're at the right place at the right time. Now, markets do work in cycles. Everybody knows that market does work in cycles. So every time there is a different winner and every time there is a different loser. Not necessarily is that a loser remains a loser for a long time and a winner remaining a winner for a very long time, right? So it's not suited for short-term goals. At the same time, you have to understand the risk that is involved in owning businesses, because businesses are dynamic. Your operating environment is dynamic. Naturally, your the businesses that you own will also go through that sort of ups and downs, right? So maximum of 80% of your net worth needs to be involved, up to. That's not that you have to reach that down. It's up to, right? So what do savers really want? Now let's get into the psyche of Indian investors. One, we want something that is tailor-made to us. It needs to be suitable, right? We want something that's diverse, right? We don't want all our eggs in one basket, right? If everything of one thing is a problem, then two less of something also is a problem, right? We want something where it's liquid. If there's something happens to me, and we are all very fearful beings. It's not only Indians, it's everybody. If something happens to me or something happens to anybody in my family around me, or if there's a bad scenario happening, I need for it to, I need for me to be able to take out my money at any point in time. Right. Then we want something that's legal. We've been through that phase of illegality and making money through illegal ways. But right now, I think the psyche is changing where we want to go straight and we want something that's very well regulated by the government. Obviously, this is not something that I need to address also. We want variety. Let's be honest. We do want some bit of exotism, some bit of luxury in whatever we do. Right? We want some variety to come in. Even when we order food, we are looking for a thali. We are not looking for a 1% burger sort of a meal. We are looking for a thali. We want sweet. We want spicy. We want to test our palates. Right? We don't want something that's very plain vanilla. We want some variety in the product. Right? Most importantly, we want some sort of discipline. A product that can sort of give us that discipline. We want to be flexible in nature, so that we go on that path and we incorporate that in the next generation that comes to us. Right? We do want to give them that inspiration that, listen, this requires discipline. This requires you to have a different mindset. This requires you to be flexible in any environment so that you can meet your goals. Right? This is fundamental Indian investor psyche. Right? Now, how do you create wealth through mutual funds? Right. We've had that sort of an argument where should I do direct stocks or should I do mutual funds? Now, with Indian investors, we understand that we want something that's tailor-made. We understand something that is suitable to us. We understand something that has some sort of a variety, something that is flexible, something that is very diverse. And the only investment vehicle that offers you something like this are mutual funds. So the best way for you to start creating wealth is to go through the mutual fund route. Right. Now, market cycles. Now, this is a very important chart, and I'll spend a good minute and a half here. We buy when the market goes up and we sell when the market comes down. The outcome is that you are having a bad experience in the entire market. That goes on to the next generation, and you don't really sort of get accustomed to that risk taking, where you don't choose this vehicle itself as a mode to or a means to create wealth. Right? But what we have to do is completely the opposite. Right? We have to build wealth throughout, and the only way for you to build wealth throughout without thinking of what's happening, whether it is going extremely high, whether it is going extremely low, we have to think of saving throughout where we create that wealth. And the only way for you to do it is to start doing your SIPs. The best way for you to do investing in any market for that matter, be it US, be it India, be it Europe, be it Japan, China, is to incrementally keep putting in money, is to systematically keep putting in money every month or every year into the market, right, as your savings. Right. So the 5 ingredients to cook the best SIP experience, it's very simple. Right? First, you don't have to think of doing things really fast. Right? The early SIP can be a test of your investing discipline. For the first 3 years, things are going to be extremely volatile. Now, we actually have a nifty vantage point, which I don't know if I have it right now with me where I can share it with you, but do get in touch with your point of contact. If you're not on the program, do sign up. We will assign somebody to you, and then you can take that conversation forward. But it was the most interesting chart that we have prepared. It's so simple, where the first 3 years are extremely volatile for any investor in the Indian market. Right? There are some years where the investment goes down 50%. There are some years where it goes down by 10%. There are some years it goes up by 15%. Now, first 3 years are always extremely volatile. Now, this is where we start getting panicky. Right? We don't know what's going to happen in the first 3 years, but we start getting panicky because we are always thinking what's going to happen. And the next 2 years after that is when things start to slowly smoothen down. Now, they don't smoothen down because things are getting better, because we have started to understand that volatility is there and we are able to manage it well. So anybody who sticks beyond that point of 5 and 6 years, for them, the investment returns itself compound at very, very high rates. They start compounding at 11, 12, 13, 14% continuously for nearly 15 to 20 years. You can see that trend going on, where you see the colors itself going from red, yellow to extremely green. Right. So slow start can be a really good start for you, but the point is for you to stick it through. Right. Once you get into that mentality that, okay, my habits are to continuously keep contributing, grow your contributions to grow your corpus. The market will reward you if you stick through. When the averaging requires you to continuously have deep pockets. So step up your SIP and grow your contributions so that you can grow your invested corpus. Right. Your additional incremental money also is going to compound at that level. Right. So only then you can sort of go to that 1 crore corpus. For you to grow your contributions, you need to, for you to grow your corpus, you need to grow your contributions. SIPs recover faster from a bear market. We always keep getting this question that if the market is down, can I start SIP? Yes, you should continuously keep doing your SIP. If you're consistent with your SIP in a prolonged bear market, then the subsequent market recovery itself will push up your SIP value much faster. Your market value will continuously keep going much faster if you're in a bear market, right? So SIPs beat indices while recovering from a fall. So if you see from a 2020 market crash, your SIP started in 6 months versus that of your Nifty 50 index, right? Your recovery is only 6 months if you continuously keep doing your SIP. But if somebody just puts one lump sum in the index, it took them 12 months for them to recover that money. Likewise, for that about 2008 market crash, 2008 was a much deeper crash than 2020, and it was a much prolonged crash. It was a very painful crash, right? It took 34 months to recover from a fall, whereas your SIP nearly 1/3 that, 18 months. Right. So SIPs definitely do recover faster from a bear market. So anytime you do understand that, yes, there is a stagnancy that's going on, start contributing more. Right. This is data that we actually calculated. Hold it to the last mile. So Indian investor psyche is discipline. The longer your investment horizon, the greater is the potential for compounding to work its magic. Right. So if you keep doing your SIP for 21 years and the market just grows at 11%, that's your compounded, what you're able to make, very minimal realistic assumptions that we have made itself would give you, a 2 crore corpus after 20 years. Even after 14 years, you'll still be able to make 80, 90 lakhs as if you just compound at very low rates. The only problem that we find is that the first 3 years determine the outcome of something that is going to happen 10, 20 years down the line. So don't let the first 3 years or the first 4 years ruin your experience in the market, because after that is when things start to get very, very stable. You're investing more, the market is growing. So that growth does come to you as a reward, right? So the final 7 years derives almost 70% of the gains that you have made at the end of the 21st year, which means you have to hold it till the last mile. You have to continuously keep putting and you have to hold it. There's no turning and switching out and doing something that's not required for you to do, right? Every installment counts. So it's clear now that the SIP is the most effective form. When the market is at its lowest, does it mean that we should not contribute when the market is rising? No, definitely not. Because investors can invest with ease and not worry about the timing of market. That is the purpose of your SIP. Right? You do not need to worry. It's monthly going. You have averaged for a long time at a low rate. At a high rate also, it's not going to matter so much to you than that of a low market. That's why when we say, okay, start investing and then keep some money for you as a chest when the market does turn, that's when you do a lump sum plus SIP sort of a strategy where you can make use of a market fall. Not necessarily that a 2 or 3% fall should be taken advantage of. No, that's not how you should look towards saving. That is not a habit that you need to incur from an investment point of view. Right. This is our behavior model here at Milestones2Wealth. In a boring market like we do consider a boring market to be a great opportunity for you to do a lump sum plus an SIP plus step up your contribution. And when the market does sort of go up, that is when you sort of start reaping the benefits. That is where markets do become exciting. It's not exciting for you to enter, it's exciting for you to slowly take a call back, right? The way you go in is when you start doing lump sums plus SIP plus STP. That is in a boring market, when you don't see any movement, when you do not see excitement going on. That is when you need to be excited. So this is the behavior model that we follow here at M2W. Right. Your next thing, insurance. Now this is a subject that is quite interesting for me also, is because now I'm not on the insurance side. So naturally, when the insurance team does come up and do a presentation for all of you, I was also part of it, and I also learned a lot from it. So I just took out a couple of slides from that, so for me to address it again. Where what are the myths about insurance that we know? Young and healthy people don't need insurance. Insurance is for investment purpose. Life and health insurance through my employer is very well sufficient. They have covered me, so I don't need to cover myself at all. Life insurance for saving taxes. This is one moment that we've heard. It is better to buy a policy in the name of a minor. I don't need insurance once my children are adults. I would rather choose a whole life insurance policy over a term life insurance policy. I have a comfortable amount of savings, so I don't need insurance. Now, let me just bust one myth. It is better to buy a policy in the name of a minor. Why? Because you're paying very low premium for a minor. Does a minor need life insurance, or do you need life insurance for your dependents? So if something happens to you, your dependents should be covered, right? So definitely it is not better. Just because you're paying low premium in the name of a minor doesn't mean that there's a great benefit happening to your entire house or your dependents. Right? These are myths that we came across when we looked at insurance. Now, what are the available life insurance products? Right, there are many, but we've been told that you need a whole life insurance policy from the time you've been born up until you die. Then there's an endowment policy where you can do this between the age of 20 up until your retirement. Right, that's when you start working all the way up until your retirement. And there's a ULIP that investors do fall into, thinking that yes, I need this for my retirement. It'll give me payouts. That is after 40 to 60. And then there's term between 20 and 60. Now, what we find is, when do you need to be insured? We do believe that for you and for anybody that's there, term insurance is the most important policy that everybody needs to be covered for. Right? All your dependents need to be covered for. And when we start working, we do need to spend a little time, look at term insurances, and start contributing towards that particular insurance, towards that particular saving. Right? You do need to think of your dependents, and term insurance is the best way for you, to sort of support your dependents if something unforeseen happened to you. Right. And if you want to know more about our insurance, please do get in touch. Our team is definitely available to help you out. Right. This is what we are doing. But among all these, term insurance is the most important policy for you to consider. Right. Your checklist to buy your insurance policy. First checklist: how much insurance do you need? Right. Check out your human life value. How much insurance do you really need? Sometimes we get so panicky about everything that's happened. We're much more insured than what our actual value is, right? That is bad capital allocation, right? Is your policy cost effective? Right? What the most important thing is, what does your policy not cover? Sometimes we get so carried away with the agents and with everybody else that no, I need insurance. So just finish this. I'll contribute. I'll start doing. And in our head, we are only thinking that yeah, we are covered. But suddenly, when something unforeseen happens, and the document does come up, and when the time comes up, we say you're not covered itself for it, and we go back thinking, oh, I've been contributing for this for such a long time and I made a mistake. Right? So take this checklist to our insurance team and tell them that I have certain insurance policies. Help me out. Right? But you can use this checklist also for yourself. How much insurance do you need? Is your policy really cost effective? What does your policy not cover? Right? I think I have just a couple of more slides. So your emergency reserve is your next line of defense. Now, let's say that you're walking on a road, you're talking on the phone. Your phone suddenly drops and the screen shatters. You realize that the phone is unusable and needs to be replaced immediately. What do you do? I think your first step would be to curse yourself. Why didn't I put a scratch card on the phone? Or why didn't I have some bit of safety around my phone where I could have protected my phone to break? Third, why was I not? Second, why was I not paying attention on the road? I'm so engrossed in the conversation, I did not see what's happening. Right. Rather than putting yourself in this position, today, when you get a new phone, the first thing that you do is open it, clean it, give it a guard, put a screen guard, put a screen guard, and put a phone cover so that nothing happens. Like, this is exactly the mentality that you need to follow. That if something bad were to happen, or if some bit of a liquidity crunch happens, you have at least 6 months worth of your expenses kept as emergency reserve in cash or cash equivalents like liquid funds or savings account or current account, something where you can easily access that money, right? Now, creating a financial health checklist. Right now, this is a very important list for you to take stock of, because here you have to chart down a monthly budget. So we've covered everything. We've covered, yes, I need to know how much. First, I need to create a habit. First, I need to create a savings habit. Then I need to look at how I can channel that habit into an investing habit. Third, I know as an investor, I require something durable as a product, a vehicle in which I can grow at a steady pace, where it allows me to contribute also more, right? Where I figured out, okay, a mutual fund is the best way for me to do. So I'm covered on the growth part. Then I look at my lines of defenses. My insurance is the best defense, my first line of defense for anything wrong happening to me, so that my dependents, the people around me, are very well covered. Last, you create an emergency reserve for anything happening to anybody in your family, with you, or anybody. If you lose a job, if something has happened at home, you need to create some sort of an emergency reserve, right? For all of this to take place, chart down a monthly budget, right? That's why I said planning is extremely important when you want to have that 1 crore goal. Chart down a monthly budget of how much you're spending, where you're spending, so that you can start saving. Where you need to cut out is what you need to look at. Focus on saving and investment patterns. I'll tell you, I'll be a little candid. Every month, I'm a binge shopper. If I see, and I'm a football fan, and I was contemplating also when the World Cup was announced, whether I need to buy an Indian jersey or no, this year's Indian jersey. Now, I'm that sort of a spendthrift, where if I see a new jersey from my own favorite football club coming in, the first thing is I swipe, and I need to have it immediately. So that's a pattern that I have realized, and such expenses is what I have started to cut down from. Right. Because these are expenses that it doesn't really add value to any. It is just an expenses that's going out. But this is a pattern that I have recognized for myself, right? And that has translated for it to be an investment pattern, because the money that I'm able to save from such things and such expenses goes down, channels down to my portfolio itself, right? Maintain enough emergency and medical reserve. There's no explanation to this. You have to maintain it. It's a given. There's nothing where you have to argue about. There's nothing where you have to contemplate about. You have to maintain one bit of an emergency reserve, right? So that can be 6 months or 7 months, or even a year's worth of experience, where you just keep as emergency. Or you have a particular goal for your medical reserve to which you're contributing to monthly as an SIP, right? Plan to prepay or manage your loans if you do have if you do have some loans that you have taken. Planning to first clear out your liabilities will in turn create a habit for you to fund for assets, right? Assets do fund for your growth. So cleaning up all your liabilities itself will create an habit in you and push you towards building more assets, right? Keep your taxes in order. Ensure adequacy of insurance. Like I said, you are aware of what we are being told outside also, which are the insurances that you need to have at any point. But we do suggest terms, so do get in touch with our insurance team to understand what suits you best. Plan for short and medium term goals. Some investment products are not suitable for short term goals. Equity is not a product that you can use for your short term goals. Debt is a product to which you can fund for short term goals and medium term goals, because here you require that money preserved, right? Your capital needs to be preserved. So you cannot go towards a risky asset thinking that I'll make more money just to fund for this goal. Even if you make less money, your goal and your objective is to preserve wealth, not to create wealth, right? And of course, plan for your retirement. So the goal of M2W is very simple. This is something that I keep repeating to investors also, is to enable investors to deal with tough market conditions, is to help investors in building versatile portfolios. And the most important thing is to set milestones to fund future growth. So today I have set a target for everybody on this webinar, saying 1 crore is the target, and for you to go towards 1 crore, you have to enter the pitch in a particular mindset. Right? And of course, our endeavor is to be a part of your wealth creation journey. I hope most of you were able to attend our conclave that we had, where you would have realized that we are a big part, and we want to be a big part of your wealth creation journey, because at the end of the day, when you are happy, of course, we will be happy, right? So this is just a disclaimer, but I hope I did not go through it too fast. So if there are any questions, I'm very much happy to address. So the first question that has come up is, how much corpus is required in fixed income? See, again, it depends on your goal. Why do you want to use it? If it's for a very short-term goal, then your corpus definitely needs to be more. But just in terms of asset allocation, at least 20 to 30% needs to be on the fixed income side, where you need some bit of regular income to come to you. Right, that depends on the stage of your life that you are in. If you are, if you are retired, then definitely your corpus towards fixed income needs to be a lot more higher than that of equity. So it depends on how much. It depends on what your goal is, and second, it depends on whether you are retired or not. The time horizon matters a lot. Please advise to invest in Nifty 50 index fund for long term, 6 to 7 years. See, anybody who's looking to invest in the index or in the market, your assumption should be 9 to 12%, right? It should not be more than that, because you're comfortably able to beat inflation, and at the same time, if you're growing at 11-12% CAGR for a very long period of time, that is 10 plus years, 15 years, then you're effectively doubling your money every 6.5, 7 years, right? So that is a good way for you to build wealth. Can I do SIP in index of both India as well as US markets? Definitely, you can look to do SIP in India, in US, anywhere in the world. But there are certain risks when you look at valuations of the market, whether it is in any given cycle. Valuations do matter. But yes, SIP works. And what you need to consider when you're looking at index funds is the concentration risk. So just to give you an example, today in India, 35% of the index is financials and financial services, right? So you are sort of running that risk that if something were to happen to the country, or if something were to happen to the banking sector in our country, then the index would lag, right? So you just need to keep certain risks in your mind, that if I am doing index investments, these are the risks that can come up. Right. For a moderate risk profile, how much percent active fund allocation is recommended? I would like to get back onto that question also, is because I want to understand, what do you mean by active fund allocation? Does it mean that you're continuously going to switch out from one thing to the other thing to the other thing, or that the money that you're investing is being managed actively and not passively? So if you can do reply to that, it will be very helpful. What are your views on opting for pension plans? Pension plans are very helpful. I think we had done a webinar where we had spoken a lot about pension plans and how they can be helpful. But this is a very interesting topic. Thank you so much for your feedback. I think I will actually take this and go back to the team for us to do some bit of knowledge sharing on the pensions that we have worked with, right? Pension plans that we have worked with. So definitely, I will go back to the team with this. What is the view on the recent microcap index with a 10-year time horizon? I understand it's very volatile. See, it is very volatile. It's not about volatility. It is about how the optimism around small caps and optimism around micro caps has been in the market. The point is that there is overcrowding in such spaces, right? And when there is overcrowding in such spaces, when something turns, it's going to affect you very badly. So rather than it going when it's too crowded, go when there's no crowd, right? Even with a 10-year horizon, if you start at a point that is extremely high, where you don't have any money to contribute more, that's why that point of incremental contribution comes in. That if something or if the tide changes, you need to have a chest that you can use to invest in a bad time, right? So if you don't have that, if you start anywhere, you're not going to make enough returns. Small caps, if somebody invested without any incremental investment at the starting of 2018 and just opened their portfolio and looked at it at the end of 21, you would just have made around 3 to 4% capital, right? Though it's a short period of time, you understand that for you to make even more money would require that investment to perform extremely well, because you have not contributed incrementally to that particular idea. So incrementally is what I would put my point across is volatility will persist. But if you start at a higher point, even if it is 10 years or 15 years, you need to have deep pockets to add to your conviction. Right? IDFC First Bank is giving 6.5% savings account. Is this good or safe to park extra amount? See, liquid funds are offering you more. Liquid funds do offer you that, and so it's a good amount of liquidity also. Whenever you require, it will immediately be liquid. It will come to you in a day. So liquid funds do offer you slightly higher. Is S&P 500 well diversified or not for long-term investments of 10 to 15 years? They are diversified, but the concentration is more towards technology companies. And if you're bullish towards technology companies, then yes, it's a great idea. Right now, do not think of extreme diversification. Do not think of extreme concentration. First, create a habit to save, and in turn, create an investment habit. Don't jump to the next step of, okay, I am already done with that. I'm already done with deciding on the habit that I want. So now I'm just going to play front foot. So you cannot play front foot, right? But for a long term, yes, it would work. Okay. You didn't mention about the debt funds in the asset allocation. I can understand that it will come under fixed income. In that case, maximum of 20% is not correct, right? It depends on the goal, risk appetite, and the time horizon. What would be advisable debt allocation for a 30-year-old? No loans, good salary, and doing SIP for long term. Can I just put the debt part in PPF, liquid funds, and FD? What are the other options for debt? Yes, see, you're 30, you have a long runway to go, and some amount can be in the areas that you spoke about. Liquid funds and FD is because your regular income is not to be covered, right? All you just need to cover up for your emergency reserve, and your emergency reserve needs to be extremely liquid, right? So do not bother much about your returns that you make out of it. Park some amount, 5 to 10%, or 6 months, 7 months of your expenses into a liquid fund or an FD. Do not think of returns. Your only thing should be how easily accessible is it for me. That's it. Would SIP work in a microcap when compared to Nifty 50 with additional lump sum on 5% dip? See, again, 5% dip doesn't really cut it out. So the thing is, 5% is nothing actually, right? When for small and mid caps and for micro caps, liquidity is a big concern. So when things are extremely bullish, the tendency is there that they would do it. Just the tendency, it doesn't mean that they would extremely do well. The tendency is there that they'll do well. But when something bad happens, you need to think of the bad time also, because the bad time can be very, very deep, right? SIP works. Definitely your SIP would do, but you need to have extremely deep pockets for you to do a lump sum, not because of the additional part that is going to come out from your side, but the patience part that is going to come out from your side, right? What will be taxing for you is not the money that you put in, but the patience that is required for your money to make money. That will be taxing for you. I think we have a couple of more minutes is what I got a message. So if there are further questions, I'm very happy to address it in the next couple of minutes. And then we can wait for the rain gods to go away. How is PMS as an investment instrument? See, for Indian investors, experience matters a lot. Okay. Anytime investors have had a bad experience with equity, they shy away from it, they never come back. One interesting story is that between 2014 and 2018, and even after that, a year later or so, PMS did extremely well because the majority of money was in small cap. What the mutual fund was not able to do, the industry was not doing, that the PMS was able to do. Right, that's where how they were working. So returns were extremely high, and people got carried away, and investors ran into PMSs. Right, and they had a bad experience because the cycle turned. So when the cycle turned, your small caps went very bad for 2 years, and the investor experience sort of now people shied away from doing equity investing at all, right? But because PMS is an all equity sort of a product, you should consider them in your equity portion. If you have that mentality, if you don't, mutual funds are the best way for you to do, because here they are very well regulated. They have been told that you need to take very less risk, but deliver market beating returns. Right, a PMS definitely will have higher returns because of the inherent higher risk that they are taking. Because some PMSs do not take that high level of risk but are able to generate higher returns. We also do run 4 PMSs, but I do not want to address it here because the idea is not for you to go towards PMS or for you to go towards a particular investment vehicle, but for you to start saving first in an easy vehicle. Right? That's why SIP is the best way for you to do, and do it in a vehicle that doesn't give you too much pain. Because once you're equipped with that, then any amount of pain you will be able to bear. Right. So yes, PMS is the next step for you to look towards that allocation of your equity allocation. But right now you bat slow. You bat at mutual fund because they are offering you high returns, because they provide a better experience, a safer experience for you to then start taking a lot more risk. That's what I would say. It appears that quant-based mutual funds are doing very well over the last years. There is high churn in these funds, and the views on long term. So we have been able to meet with a lot of quant fund managers. That is, fund managers managing wealth through some bit of algo and some models they're using. See, every model is different, is what we've understood. And see, once you put a model out there, it's very easy to replicate it. Right, so it will never be completely algo, or it will never be completely quant based. There has to be some bit of fund manager interference in it, because when you run a particular model, or when you just filter out high ROC something, you put in your models, you get some names that you might not be comfortable with, the fund manager might not be comfortable with, based on legacy issues of corporate governance. Right, so that is where fund manager interference does come in, where they filter out that particular model and then they try to run it. But once you understand a particular model, it's easy to replicate it. So it's a very niche segment, and it will only get nicher, it will only get smaller, it will only get more complex, it will only get more specific. Right. So long term, there's no need for you to immediately jump into it. it's good for you to see what has been happening in the market. Right? But we did do a good amount of study with quant funds, and we have actively stayed back. Thank you so much for joining in. I don't think we have any further questions. So I'll close, and let's hope India wins today. There is one last thing. I've enjoyed the M2W program last year, but didn't receive any update from the team regarding market conditions or time to put a lump sum. How to get that update? How do you get an update? So we will get in touch with you. So lump sum opportunities are only now coming in. You will receive updates now. Because we did have a discussion on what lump sum opportunity to look at right now. So you will get an update now. Done. Thank you so much for your time. Thank you so much, madam. Cheers. Have a good weekend ahead.